Friends, very good morning and welcome to our today's session. As you know, we are going to discuss two concepts. One is the concept of micro insurance, and the second one is the concept of reinsurance. Both the things we'll be discussing now. So I'll be sharing the screen with you right now. Yeah, first let us learn what is micro insurance. So you must be having some basic idea about this. Micro insurance means you can say it's a insurance to cater the need of poor people, or let us say where the insurance amount or the policy value is very, very less. So let us try to understand what is that. So this IRD, or the Insurance Regulatory Development Authority, has created a special category of insurance policy to meet the need of this type. And these policies are referred to as micro insurance policies. Objective is to promote insurance coverage of the economically vulnerable sections of the society, people who are economically poor, and there is a need, they're exposed to various kinds of risks, and micro insurance can address to those risks, those problems. So that is the objective of micro insurance. And the IRDA has passed a regulation, that is Micro Insurance Regulation 2005, which defines what is micro insurance. Okay, so we'll look into that regulation. But as of now, I have this idea that this is intended to address the problems of the economically vulnerable sections of the society. Okay, and technically, if you see what is micro insurance, it may be a general insurance, it might be life insurance also. So two possibilities are there. You have already know earlier what is life insurance, what is general insurance. But the micro insurance policy is normally within a form of within an amount of, that means the sum assured amount should be rupees 50,000 or less. If it is more than 50,000, then we will not call it as micro insurance. As you know, intended to cover the low income households or individuals who have little saving. So as usual, the premium amount will also be low. So in fact, IRDA monitors this micro insurance policies, sees that premium amount is less, policy that the sum assured is maximum up to 50,000. And these policies are tailored specifically to address the need of the people or the need of a particular community. So in case of some uncertainty like illness, injury, death, these policies helps a lot the community, the people, right? And this regulation will be seen after certain time, or we can do one thing right now. Let me take you to the IRDA website so we can see that what is this micro insurance regulation, and through that we'll be trying to understand what is that. So let me take you to that website. Just a minute for that. Yeah, are you able to see the screen now? Google homepage. So
Yes, sir.
I am going to IRDA website. Yeah, irda.gov.in. I am visiting there. Yeah, are you able to see it now?
Yes, sir.
Okay, so where you see on the left hand side, you see the so many links are there, so many tabs are there. Here, one of the link you can find here is micro insurance. Are you able to see?
Yes, sir.
Okay, so now let me first show you the micro insurance products what are available. Then we'll see the regulations. Regulation is important for us. Products you see, of course, this is a little old list you can find out. Yeah, these are the micro insurance products. Okay, so you can say these are the various insurance schemes. On this column, you see the name of the product and who is providing that service. The name of the insurer or the name of the insurance company is here. These are the various products. So one can opt for these products. Okay, these are the products which is available as per the list provided in IRDA website. Okay, got some idea? Let us say,
Yes, sir.
okay, any product you can say. SBI Life Gramin Shakti, SBI Life Gramin Super Surakya, SBI Life Gramin Bima. Okay, ICICI through Anmol Bachat. Right, so these are various names of various products. Now we'll be seeing the regulations, which will explain us what exactly this micro insurance is. So now if I take you to the micro insurance regulations, now you see micro insurance regulations are here. Are you able to see the link? Yes or no? Are you seeing it?
Yes, sir.
Yeah, you see this is the micro insurance regulations. Now you see, let me download it for you. You can say IRDA micro insurance regulations 2005. Okay, this needs to be downloaded, then only you can access. So I have downloaded that regulation. Now let me show you that. Oh yeah. Are you seeing it now? Is it visible to you?
Yes, sir.
Okay.
Yes, sir.
The top portion, this it is coming in Hindi. Let me go to the English part of it. Yeah, it starts from the, you see, Micro Insurance Insurance Regulatory Development Authority has released this thing. Insurance Regulatory and Development Authority Micro Insurance Regulation 2005. Okay, if you want to understand what is micro insurance, then you have to refer to the definition provided here. Okay, you see, one of the definition, you see what is life micro insurance product. Means any term insurance contract with or without return of premium, any endowment insurance contract or health insurance contract with or without accident benefit rider. That means there is a possibility of adding accident benefit to it also, either on individual or group basis, as per the tops stated in Schedule 2 appended to this regulation. So this is one definition. Schedule 2 also will be same. Okay, you see, these are, you see, micro insurance agents. You see various kinds of micro insurance agents are there. Okay, you see non-government organization, NGOs are a group of, are some agents, self-help group, micro insurance institutions. So these are the three categories of agents. What is the meaning of NGO is explained here. What is the meaning of SSG, self-help group? What is the meaning of microfinance institution? That is also explained here. Okay, and next it explains what is micro insurance policy. Means the insurance policy sold under a plan which has been specifically approved by the authority as micro insurance product. Okay, and what is micro insurance product? Includes general insurance product, all life insurance product, proposal form, and all marketing material in respect thereof. So these are the definitions which is provided in the regulation itself. How this micro insurance products will be distributed, how agents will be appointed. Okay, then what will the role of the agency, what will be doing, like collection of proposal form, collection of self-declaration form, how this will be marketed. Okay, and code of conduct for the agents. Okay, now you see other things are remuneration of the agent, right? So these are the various things which are included in this regulation. Okay, now you see these are the various category of insurance, such which can be called as the micro insurance as per Schedule 2. You see, term insurance with or without return of premium. Minimum amount 5,000, but is the maximum amount 50,000. 5 years. Term cover is 15 years. Minimum age is 18 and maximum age is 60. So this is, if the policy comes under this, it can be regarded as micro insurance product. Then endowment insurance. You have seen the maximum amount is 30,000. Health insurance, max amount is 30,000. Health insurance contract with family, max 30,000. Accident benefit rider, max 50,000. So maximum amount can be 50,000. Okay, this IRDA regulation will help you to understand or to get the complete idea about what is micro insurance. Okay, now if you summarize this regulation, let me show you the PPT now. What is there in the regulation? Those things are summarized in this PowerPoint presentation. So now you have understood micro insurance policy can be for a sum assured of 50,000 or less, intended to meet the requirement of the low income households. It may be tailored to suit the specific needs of people, right? And it can be a general micro insurance product or it can be a life micro insurance product. If it is a general micro insurance product, you see, it may be for health insurance. Okay, or it may be for any contract covering uncertainties involved with these kind of things like a hot livestock, tools and instruments, any personal accident contract. Okay, like hot insurance, livestock insurance, tools insurance, these insurances can be covered under general micro insurance. And they can be taken by an individual or it can be taken by a group also. So this is about general micro insurance product. Coming to life insurance product, it can be a term insurance contract. You know what is term insurance? Earlier we have discussed this thing. What is endowment insurance? We know it can also be a health insurance. It can be with or without an accident benefit rider. This may be an additional coverage of accidental death or accidental injury that also can be there. These policies, that is life micro insurance policies, can also be taken by individuals individually or on group basis also they can be taken. Okay, so you might be thinking, you see, this life insurance product is coming under life micro insurance, it's also coming under general micro insurance product. You see, there is a flexibility. IRD has allowed flexibility of this micro insurance product. So as per this regulation, the insurers can offer composite covers or packages products that includes life as well as general insurance. Okay, for micro insurance product, there's a possibility that it can be a product which is a composition of both. It may be covering some life element in it, and it may be covering some general insurance element. So that possibility is there. Right. So now you have understood. So this policy has a, this is the premium rate is normally low, and there is an upper cap as regards to sum assured. Low coverage limit, specific age limits are there. Right. So intended to meet the requirement of the low income people. And these are the agents, you can see these are the intermediaries. You have already seen the IRDA regulation, which explains who are the intermediaries for the micro insurance products are marketed by who. You have already seen there are 3 categories of intermediaries. Right? Who are they? Can you read it out? Intermediaries of micro insurance business. Can you read it? Can anyone read it out?
The non-government organizations, self-help groups, and microfinance institutions.
Okay, good. And who are they exactly? We have discussed, and let me show you once again. That has also been explained in that micro insurance regulations. When you've seen that those things were there. Just a minute late. Once again, I'm trying to show you that. Now have a look at this regulation, IRD regulation. It says micro insurance agent means these three entities: NGOs, SSGs, and MFIs. That's microfinance institution. Okay, NGOs. What are the meaning of NGOs? Means non-profit organizations registered as a society under any law and has been working at least for 3 years with marginalized groups with proven track record, clearly stated aims and objectives, transparency and accountability as outlined in its memorandum, rules, bylaws, regulations, as the case may be, and demonstrates involvement of committed people. If these things are there, then an NGO can become as micro insurance agent. SSG group can also become a micro insurance agent. Means small informal group consisting of 10 or 20 or more persons, and has been working for at least 3 years with marginalized, with proven track record, clearly stated aims and objectives, transparency and accountability as outlined in its memorandum, rules, bylaws, or regulations. So all these things are there, then that SSG can become a micro insurance agent. Or any microfinance institution can also become microfinance institution, means an entity or association registered under any law for registration of societies, cooperative societies, as the case may be, inter alia, for sanctioning loan or finances to its members. So these are the, you can say, three category of intermediaries: NGOs, SSGs, and microfinance institutions. Okay, regulations I told you broadly. So the critical features also by this time low cost insurance. It is intended for low net worth people. Most of the cases, communities are involved. A group of people join together and take micro insurance policies. Normally that happens. And it's a very helpful tool to manage the risk. It enhances the risk management of the members, risk management of the people involved. Right. So various risks are covered, like life risk or health risk, hospitalization, primary health care, maternity, etc. All these kinds of risks or these kinds of uncertainties are covered. Okay. Property insurance also can be done, like assets, like stock, housing insurances. And crop insurance is also one more form of micro insurance. Okay. There are various factors that affect the micro insurance business in our country. First of all, there is low or limited present coverage. That means limited number of policies are available. Limited number of insurers are offering these services. And willingness is also low. Very less number of people are interested to go for this kind of insurance. All the social sectors are not included. There is very low awareness among people about like micro insurance products. Okay, there is managerial operational capacity gaps. That means practically managing the life, managing these micro insurance products, and meeting the objectives of those products are a difficult task. So therefore, insurance companies faces a lot of challenges to design a product to suit the requirement of the people. So these are various issues like this. And pricing is one more issue. How to decide the premium, since it is intended to meet the people who are having low income. So the premium fixation of premium is a big challenge, and premium should be fixed in such a way that uh, that the loss can be that the pool created out of that premium should be able to meet the loss which may be possible in future. So those challenges are there. Okay, as you know, it covers various risks like crop risk, the damage to crop, livestock, cattle, theft, fire, health, term life, death insurance, disability insurance, natural disasters. Most of the things are covered. Okay, so this is about micro insurance. I think you got some idea about this concept of micro insurance. If you have any query on micro insurance, you may ask right now. Otherwise, we'll move to the next topic, which is reinsurance.
No, sir, no doubt.
No doubt you have understood. Now, can you tell me what is the maximum amount of sum assured for a micro insurance product? What can be the maximum amount of sum assured? Can anyone tell me? Okay, I'll be showing you that regulation once again. Now, one more question. Can anyone tell me that who can become the agents or intermediaries? Who can become the intermediaries of micro insurance products? Can anyone?
NGO.
NGO. Okay.
NGO self-help groups.
Self-help groups. Good. And one more. One more. Who can tell me? Who can tell? Okay, both the things.
Commercial enterprise.
Sorry?
Commercial enterprises.
No, not commercial enterprises. The exact wordings which are used in the regulations are different. Can anyone tell me? I'm showing you once again. Let me share the screen with you. You see what you are saying here. Can you read it here?
Microfinance Institute.
Yeah. So non-government organizations, self-help groups, and microfinance institutions. And the previous question answer is also here. Previous question was what is the maximum amount for which what can maximum amount of sum assured? Now tell me what can be the maximum amount of sum assured? Can anyone tell me?
It is 30,000 per asset.
Question is maximum. Serial 1 I am showing you. I'm showing you serial 2 now. Question is maximum.
50,000.
Yes, that should be your answer.
50,000.
Yes, that should be your answer. So this is about micro insurance. I think broadly you have understood. You'll be able to handle the question on micro insurance. Now, friends, quickly we'll be covering the next concept, which is about reinsurance. So reinsurance, as the name itself says, it is an insurance on insurance. Sometimes what happens, the insurance companies themselves, they transfer the insurance risk. Insurance company, suppose you are taking an insurance. Why you are taking a risk? Why you are taking an insurance? Because you feel there is a risk. Is it? And by taking insurance, you are transferring that risk to the insurance company. Right? Suppose you have taken a health insurance policy. That's because you feel there might be situation where you may get hospitalized. And this hospitalization expenditure may go up to 5 lakh rupees, and that will bring a financial loss to you. And to have protection against that financial loss, you have taken a health insurance policy. Okay. And similarly, this once you've taken a policy, now what happens? The risk is transferred to the insurance company now. And insurance company is taking that risk. An insurance company might have taken so many risks like this from different people, from different companies, from different sectors, varieties of risks. Sometimes they feel that they have already taken too much of risk. In that case, they may decide that they would like to transfer that risk to some other insurance company. So you can say this is the insurance by the insurance service providers or insurance of the insurance companies. Okay, and this process, the process of transferring risk to another insurer is referred to as reinsurance. Okay, reinsurance is quite popular, very popular among insurance companies. Micro insurance may not be that popular because products are limited, awareness are limited, right? And people who are for whom this product, micro insurance products are exactly designed, they may not be interested. So those issues are there. But so far as reinsurance is concerned, that is a very important concept and very popular at the insurance companies. And that's a requirement also. Many times insurance company feels that they have already taken the risk beyond their bearing capacity. Beyond their tolerable limit, they have taken the risk. Now, option available with them is that they need to manage that risk. How they will be managing? They will transfer the risk to some other insurance company. So now, friends, quickly let me share the screen with you. With the help of that, we'll try to understand what is this concept of reinsurance. As you can see, reinsurance is the practice whereby insurer transfers portion of their risk to another party by some form of agreement to reduce the likelihood of paying large obligation resulting from an insurance claim. Because insurer feels if there will be insurance claim, he has to pay a large amount. And to have protection against that, they may take a reinsurance policy, or they may, you can say, they may diversify the risk taken by them to another company. And the party that diversifies, or the party who is interested in taking that reinsurance policy, is called as the ceding party. Okay. Now, reinsurance occurs. When reinsurance happens, when the multiple insurance companies share the risk. Because in that situation, what happens? No insurance company shows interest to observe the entire risk. They want to share the risk. How they share the risk? By purchasing insurance policies from another insurers to limit their own total loss in case of disaster. So they feel if the disaster will come, then they have to face a huge loss. So they reduce that loss by purchasing another insurance policy. By doing this, they're able to spread the risk. Okay, this is the concept of risk spreading. An insurance company takes on the clients whose coverage would be too great for the burden for a single insurance company to handle alone. That means one single insurance company feels that the burden is too much to be handled. Okay. They would like to share the risk with others. That is called the insurance. And when the risk is shared or the responsibility is shared, premiums are also shared. So typically, the premiums are also shared among the reinsurance service providers. Did you understand? Got some broad idea about reinsurance?
Yes, sir.
Okay. Now, friends, let us try to understand in a different way. So it is a type of insurance which is purchased by insurance companies. So reinsurance is purchased by insurance companies. It's not purchased by general people. It's not purchased by, let us say, insureds. It is purchased, right? It is purchased by the insurers. Or it may be purchased by self-insured employers. Sometimes employers might have taken self-insurance of their loss. Okay, so they may also go for reinsurance. There is one more kind of reinsurance which is called the financial reinsurance. So it is a form of reinsurance which is primarily used for capital management rather than transfer of insurance. Now you see, if you as a student of business, you know that every business takes some risk. Okay, and every business has got a risk bearing capacity. If they take beyond that, there is a possibility that business may not be able to continue with. It may not be able to sustain. So by assessing the position of the assets and liabilities, or by assessing the balance sheet position, one can easily understand that how much risk one should take so that the solvency level doesn't get affected. If you take too much of risk, there is a possibility that that business may become insolvent. So our intention is that the solvency position should remain intact. Business should remain solvent and business should come. Is it not? So in pure situation, if somebody feels that my capital is inadequate or I have taken too much of risk, so to manage the capital and to ensure that the capital adequacy ratio are maintained, so one may reduce the risk. And this reduction is possible by taking reinsurance. Okay, you can reduce the risk by going for reinsurance. So if this is so, you can say this is a purely financial reinsurance. Okay, or to strengthen the balance sheet or to ensure that the business is sustainable, this kind of reinsurances are taken. Hope you got brief idea about this. Now, reinsurance is paid the insurance premium. Insurance premium is also shared. The original insurer pays to the reinsurer or shares the insurance premium with the reinsurer. Okay. And the main objective or the main purpose of entering into this kind of reinsurance contract is to transfer risk. Here is an example before you. Suppose an insurer sells 1,000 policies. Each policy limit is 1 lakh rupees. Theoretically, if the loss happens, the insurer could lose 1 lakh on each policy. So 1 lakh into 1,000. And the total amount of loss possibility can be 1,000 lakh. If the insurer feels that this is too much, in case actually this loss happens, they may not be able to sustain the impact of this loss. So he may feel it is better to transfer some risk to another insurance company. So he may reduce the risk. Okay, so this is how this is exactly the concept of reinsurance. This is what happens in reinsurance. And these are the functions of reinsurance. In a reinsurance mechanism, risk is transferred. And when the risk is transferred, income becomes smooth. Income becomes smooth means suppose you have received excess premium for excess risk. Now you are transferring the part of the income, transferring to another party. The risk is also minimized. Your income becomes smooth. Maybe in some other year, suppose your premium income is not much. So you can also take reinsurances from some other insurance company. So among insurance company, there will be a possibility of smoothening their income. Okay, surplus relief. This is the concept. Suppose this is the concept means like this. Insurance company always like to take the risk which is allowed or which is possible, keeping in mind their solvency level. So they feel that solvency or they always take decision in such a way that their solvency level is not getting affected or solvency margin is not getting affected by taking the risk. Okay, in case they feel they have taken excess risk, they'll be sharing that risk with other insurers. By doing so, they'll be able to get a relief that the risk is shared, solvency margin is maintained. This concept is called the surplus relief. Arbitrage is a concept through which again risk is transferred. If you feel you have purchased or you have offered some insurance policies with low premium, or you have collected high premium, so you can sell it to another insurer with low premium. By doing so, you can get a margin. Or another situation, or another possibility when reinsurance might be required is the reinsurer's expertise. Suppose reinsurer is expert in handling a particular policy. Suppose reinsurer is expert in handling a fire insurance policy, and you are expert in handling a marine insurance policy. Suppose in case you have taken a marine insurance policy along with that a fire insurance policy, the fire insurance policy can be reinsured. It can be transferred to another reinsurer. Okay. And reinsurance also helps in managing profitable portfolio among the risk. That means a good combination of portfolio investment you can create with the help of reinsurance. Right, a basket of policies you can create. Cost of capital of the insurance company can also be managed with the help of reinsurance, because too much of policies means too much of capital investment. With less policy, you'll be able to manage the business with low capital. So that is also possible by transferring the insurance business to some other entity. It has got many advantages. Okay, of reinsurance. Risk premium is kept within the tolerable limit. Original number of policies are also reduced. It brings stability in the business. Right, it brings consistency in the business income. It gives protection against uncertainty. Okay, so these are some of the advantages of the reinsurance concept. Friends, I think you got a fair idea about the concept of reinsurance. Is it clear to you up to this?
Yes, sir.
Okay, anything you would like to ask on reinsurance or micro insurance?